Hello, welcome to this episode of Rich Insights. I'm Don Rich, the head of investments for Esoterica Capital Management. Now, today's topic is trying to make sense of the energy markets. Right? I don't know about you, but things seemed simpler when I was a kid. Right? I had my tumbleweed as my pet, and safe sex meant you pulled off to the side of the road. Things are more complicated today. Particularly I'm thinking about commodities and oil in particular. How is it that Russia and Saudi Arabia came to the conclusion that they should be flooding the market with oil in the presence of the tremendous demand destruction that we're witnessing today? That just seems absurd. And I want to walk through that. There's some theories being floated, one in particular that I'll discuss, that suggests this may be a very rational move on their part. All right, but again, we want to talk about commodities in general. So let's go ahead and get started here. Let's get back to the charts. So we have the performance here, year-to-date performance in dollars of various commodities. We have U.S. crude prices down 67%, right? This is West Texas Intermediate crude. We have global crude, or Brent, down 66%. And you can see gasoline. Gasoline's also down the same amount here, 66%. Right? They've lost 2/3 of their value so far this year. Wow. Now, diesel fuel and heating oil each down about 50%. Natural gas, a little over 20%. The point is, this demand destruction has been broad-based, right? It's hitting all the segments of the energy complex. But it's not just energy. Let's go over to metals, particularly copper. Copper is one that I follow very closely. Copper's down 23%. And also what's interesting here in metals is look at the safe havens. Right? As you might guess, gold has served as a safe haven. Right? It's up about 7% on the year. But the real safe haven has actually not been gold, it's been palladium. And we get down here to the ag commodities. You can see most of the ag commodities are also under pressure. Again, this demand destruction is broad-based. No question about it. So the two commodities I want to talk about in particular today are copper and oil. So we got a couple charts on copper. This is copper inventory levels. Now again, remember, copper has been down 20 to 25% compared to oil down 60 to 65%. But the thing that worries me about copper is that who's been buying copper recently? Well, you can see it's those building up their reserves, right? Copper inventory levels are near the highest levels that we've seen in recent history. All right, so if you take this buyer out of the market, since inventories are full, if this buyer leaves the market, you've got to be wary that there might be some downward pressure coming. Now, let's go to the next chart. What we have here, this is one of my favorite charts. We have this pink line. It's a little hard to see, but this pink line is the price of copper divided by the price of gold. All right, so copper being a measure of global growth and gold being the safe haven asset. All right, and in addition to this white line on the chart is U.S. 10-year interest rates. All right, the first thing you can see are both are extremely low right now, right? The lowest we've seen during this time period. But you can also see they tend to track each other pretty well. Not perfectly, but certainly not bad either. And I tend to think that we're going to see negative interest rates. It's the only way that I can see to give us a debt deflation that we need to get out of the predicament that we're in. We'll talk about that more later, but what does that mean for this chart? Well, that means this pink line's got to continue to go lower, which likely means lower copper prices. All right, let's shift our focus over to oil now. Again, we'll start in the same spot. I always like to start with inventories. Well, we see, based on weekly information from the Department of Energy, the inventories we're looking at here are those that do not include the Strategic Petroleum Reserve, right? Just to make sure we're all looking at the same thing or thinking about the same thing. But what we see in terms of oil inventories is they're still quite high. They're not the highest that we've seen, but they're still quite high. So we have $20 oil and we have a lot of inventory on the sideline. That's obviously not a good indication. It suggests that oil prices may go lower from here. Now, let's get into a deeper argument. All right, oil production. Each week, the Department of Energy puts out U.S. oil production. And you can see as of last week, the most recent print, March 20th print, was 13 million barrels per day. The U.S. is producing 13 million barrels per day. Now, notice this chart. We're looking at the last, 40, 45 years of history here. We've never been close to producing 13 million barrels per day, right? This is just amazing. Now, we have to put this in perspective then. This is 13 million barrels are what we're producing. What are we consuming? Well, as of last week, we were consuming 21 million barrels per day. All right. Now, also notice from this chart, perhaps it's a coincidence, but notice from this chart that our oil consumption is back to the levels it was right before the great financial crisis. We're just back to the peak we saw last time. Now, that may just be a coincidence, but I think that's a rather interesting observation. All right, so let's get back to the bigger issue here. When you see the actions of Russia and Saudi Arabia flooding the market, that seems to make about as much sense as urinating into the wind and expecting to stay dry. However, if you think about a bigger picture, a longer term view, there's one theory that suggests these guys are playing the long game. Part of the motivation for doing what they're doing is actually to push U.S. oil producers out of the market, right? To get rid of that 13 million barrels that we're currently producing. Again, 13 million barrels being produced versus 21 consumed. That means we're 60% self-sufficient right now. And of course, that gives us a lot more flexibility than we've ever seen in the past. So perhaps, again, the long game here is what they're really trying to do is destroy the U.S. oil infrastructure, the U.S. oil industry. All right. Again, just a theory. Perhaps the move is not as ridiculous as it seems. Okay, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.